Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hello, everyone. Welcome to Travillian Next. I'm your host, Brian Love. I head the Banking and Fintech practice here at Travillian. If you don't know, Travillian assists financial institutions and fintechs across the country in their talent advisory and recruitment needs, from the board level to the executive team and beyond. I'm really excited by today's guests. These are two gentlemen I've known for quite some time. I'll actually let you both introduce yourselves, but first I will start with Jeff Cardone, partner at Luse Gorman. Hi, Jeff.
Hi, pleasure to be here, Brian, and Mike, nice to see you as well. Jeff Cardone, Luse Gorman. We're a law firm out of DC. We focus almost exclusively on representing depository institutions, community banks, and credit unions, various transaction matters. So real pleasure to be here.
Thanks, Jeff. Good to see you again. Also here is Mike Bell from Honigman. Mike, could you introduce yourself?
Yeah, Brian, it's good to be here. And as Jeff said, it's good to be with Jeff. We work together a lot, myself and Jeff, and then just my firm and Jeff's firm is a small space, this depository institution space. Within that space, I'm strictly a one-trick pony, though. I'm only smart enough to do one thing. And in that space, we work on the buy side. So we essentially specialize in working with depository institutions, helping them buy other depository institutions or businesses or branches or kind of any fragment or piece of that. I will say, both Jeff and I, just so the record's straight, work nationally, right? So my law firm happens to have its world headquarters in Detroit, Michigan. For what it's worth, I live in Florida, but I can say that there's depository institutions in every state that I work with, and I know that's the case for Jeff as well. It's a national practice, very focused on the deal side.
Well, thanks, Mike, and also thanks, Jeff. And you guys hinted at it, the genesis of inviting the two of you onto this webinar, and this is a long time coming because there's been that trend, and everyone talks about it, everyone murmurs about it. There's been some peaks and valleys on these deals, but it's the credit union buying the community bank deal. And there's a lot of different perspectives on this particular type of deal. I hope to cover several topics with you today about these deals. I guess we'll start quickly with the fact that Jeff, I've known you for several years, as I mentioned. Tell us about how you help in the credit union bank deal space.
Yeah, I mean, I would characterize myself, and I'm sure Mike would do the same with him. Our role, we're deal attorneys. So, I mean, you have to wear many hats as a deal attorney. So obviously beyond the nuts and bolts of, drafting a contract, et cetera, you got to understand all aspects of the transaction, on the financial side, the regulatory piece, et cetera, integration, getting to close. I mean, there's various steps, in terms of phases. And so our role is to kind of be, whether we're representing the credit union or bank in these transactions, there's a lot of complexities to them, is being with the institution through every phase, whether that's as a strategic advisor, negotiating the definitive agreement. Mike and I spend a lot of time with the valuation firms. Like, we kind of understand, the math behind these deals, how they're priced, how credit unions can win, sort of how banks, and even from the bank's perspective, what they're looking for in terms of finding a viable partner. So it's really the scope of the practice is to do what we do is you have to understand the transaction and all aspects of it.
And Jeff, we were just talking, you were primarily on the bank sell side to credit unions, but more recently you've actually been helping credit unions on the buy side.
Yeah, and as I mentioned before, I mean, our firm's background, Luse Gorman, we were founded primarily with mutual banks, converted thrifts. And, once they go public and they decide their their board from a fiduciary duty standpoint, look, they want to have strategically partner with somebody else. we were finding there's a lot of synergies with credit unions. So we were on the sell side in a lot of these deals working with Mike. And, as a result of that, we sort of have that expertise and, that kind of transferred over on the credit union space.
Sure. And Mike, since, I don't know, 2017 or so, we've been talking and these deals have, kind of increased in volume. And you've been, in my mind, and maybe the audience's mind, kind of synonymous with these deals. You are mostly on the buy side of these transactions, correct?
Yeah, Brian, that's right. I'm only on the buy side. I just limit it to that. I mean, because that's what we do. And Jeff's point is really correct in that I'm certainly a lawyer. I work at a law firm, right? That's what we do. But these are different such that we're in this start to finish. We break it down in 4 different phases, and it's awfully operational. It's best practices, it's strategy, it's valuation, it's math. There's certainly a legal component, right? There's a definitive agreement. There's regulatory pieces, don't get me wrong. But we kind of stand next to the buyer before they ever start drafting legal documents and work this deal. And we stand next to the buyer post-closing when the legal work's done and help them integrate, right, this deal and work through it with them. Because I will say this, I believe this is best done, right, multiple times. So certainly it's great to be a buyer once. Don't get me wrong. And you could be a buyer once and never buy again. And I think that's worthy and wonderful. I will tell you the best in this space, right? Bank or credit union. I could stand up multiple community banks as well. The best buyers in this space buy 1, 2, 3, 4, 5, 6 times, right? They build those talents, they build those skill sets. Mm-hmm. So that's how we build it on the buy side. We build this so it's repeatable, it becomes more efficient, and it gets better with time. And there's a long life cycle to our representation. And I want to add one thing, right? We're not everybody's everything. So I'm not trying to do the day-to-day lawyering for this institution. And Jeff and I were talking about this the other day. You have your general counsel, you have other lawyers to do other things. We're not foreclosing on mortgages here, right? We are focused on transactions, period. And that makes us different. Anybody can grab some paper and fill in blanks, right? But this is transactional in nature, period. And it's a different kind of deal.
Well, on that, if you guys are the deal guys, let's talk about the macro lens of M&A at the moment. Obviously, last year, the volumes were down. They've been fairly low even this year. It's an election year. There's a lot of uncertainties around credit. Obviously, some odd news in the bank sector in the Northeast, of course. So tell me a little bit about what you expect from M&A this year, both from a macro lens and then also on the, keeping in mind the topic of this webinar around credit unions and banks. Jeff, if you want to go first.
Yeah, I mean, I would say at a macro level, M&A is just going to be down. And I think the real primary reason for that, Brian, is it's a math problem. If you look at a lot of banks, it's really a purchase accounting mark where you have to, adjust or right size the fair value of a seller's loan portfolio, the investment securities. From a buyer's perspective, as a result of doing that, it makes these deals too dilutive. So I would characterize like our traditional client base, call it $1 billion, $1 billion to $10 billion publicly traded depository institutions. In that space, I think M&A is going to be down without question for that reason. However, what we're seeing is as a result of that, you're seeing an emergence. This is why you're seeing a lot of trends with credit union bank deals, even investor groups buying banks, because those players have scale, they have cash. And from a seller's vantage point, we've been in the boards with sellers. At the end of the day, with given the uncertainty environment we're in, boards, shareholders of a selling bank, they want price certainty. And the only way you're going to get price certainty in this environment is cash. So while I think at a macro level, M&A is going to be down, I think M&A involving these, and I don't use this term disparagingly, second-tier buyers, whether it's credit unions, investor groups, I think that we're seeing that fairly consistently grow. At the end of the day, I don't think credit union bank deals is going to represent, 100 plus per year. But probably what we're seeing, I mean, I think the high point was what, Mike, 16 or 18 in 1 year. We'll probably exceed that in 24 from what we're seeing.
Yeah, and so, Brian, I'll just jump in
Sure.
on what Jeff said. So first, I agree, and let me expand. So he's right. I think credit union buying bank or investor groups buying banks remains always the minority of the deals, right? There's no question about it. But I would tell you, I think this year we break the record of the most ever. I firmly believe that. So far, as of earlier this week, we just announced a deal. I think 6 have announced so far this year. Wow. I fully expect, barring an act of God, that we may hit 20. We may go north of 20. And here's why. I think if you look at the 3,900 or so banks that are 1 billion or less, right? Jeff just talked about billion to 10. I agree. Look at the billion or less. I think there's activity there on the sell side. Whether it's because they have to, or they want to, or it's a mix of the two, or Brian, there's succession planning issues that ought to ring in your ear. But make a list of the soup that a $1 billion or less bank is eating at the moment. And I think that some of those folks, or more of those folks, are going to have to sell or want to sell, or find a cash buyer with certainty who will sell. So I fully expect more activity at that lower level of the market. And I do think we break a record this year when it comes to, again, not disparaging, but these other buyers or the secondary or different type of buyers that you normally see.
Yeah, and I would just add one last thing, and I agree 100% with what Mike said. The other thing you have to bear in mind, too, look at the regulatory environment we're in. I mean, I think the average number of days a bank-to-bank merger from deal announcement to closing is up to like 160 days. And so when you look at that dynamic, a buyer has to be very, very selective of who it's going to partner, because you're really going to be sidelined from any future activity till you get that deal behind you. So from an acquiring bank's perspective, as they're getting larger and larger, these sub $1 billion banks become less and less attractive. So so beyond sort of the macroeconomic headwinds we're seeing right now, you also have to consider that factor as well. And so as a result of that, kind of those converging factors, that's where, credit unions are coming in and kind of filling that gap with these smaller banks.
Sure. Yeah. And just, maybe for one little kind of side note on the succession piece, out of those 16 deals that 1 year, how many were succession driven? How many were bankers saying, this is not sustainable, and we don't feel like going down the road, finding new talent externally, and there's no one internally to solve this problem?
Yeah, Brian, I don't think so. It's tricky because you're never going to see that in the proxy statement, right? I don't think that's ever, but I think if you want to look at those 16 deals and you want to look back at the age of the CEO of those banks, I think many of them are older than 70, right? Or, I think you can kind of read the tea leaves and understand, or I think you can just look at where the banks are and make yourself a $1 billion or less institution in a rural market and try to find some talent.
Yeah, another thing I add, Brian, too, is on the succession side is at the shareholder level.
Yeah,
that's driven a significant number of deals, because at the end of the day, particularly we have a lot of these closely held institutions, there's no public market to offload their stock. Well, how are you going to have a liquidity event? Well, obviously a sale will accomplish that, and that definitely leads to deal making. But definitely the age of the CEO or the management team tends to be on the higher side when it comes to a sale. That's without question. Interestingly, I think S&P put out a report. I think the median age of bank CEOs, I think it's like 60 or 61, but for a selling bank, I think it was 67 or 68 years old.
Wow. Yeah, that's good data.
I forgot who put that. It was S&P or something, but that was really, not surprising. That's what we're seeing, but to actually have actual data backing that up, shows that succession is certainly a function driving M&A activity without question.
Okay. So moving on here, I'm kind of curious, Jeff, you've been on the sell side of these deals. Mike, you have not. Which side's harder to do? What side's harder to be on?
I think they're equally hard. I think from a selling bank's perspective, you spend a lot of time. There's a lot of education behind these deals, because one of the things that I don't think, because, there's a sentiment out there where credit unions are just grossly overpaying. They don't know what they're doing. And I would say that's not true. Remember, the way these deals are structured, bank to bank, if you're paying, for example, let's say $20 million for a bank, and let's say it's an all cash deal, bank is going to write a check. That money is going to go directly to shareholders. That 20 million, bank takes everything, the acquiring bank. Conversely, for that, if you're a credit union and you're buying the bank, because you have to structure it as a P&A transaction, that 20 million goes to the bank first. And then once the bank dissolves, pays off transaction expenses, deals with any impermissible assets, sub-debt, et cetera, whatever's left over goes to shareholders. So from the banking's perspective, you really have to spend a lot of time looking at what's the net amount you're going to get. So on the front end number, that 20 million could be 1.5 of tangible book or whatever, not 9x of earning, whatever it is. But what actually comes out is likely to be less. And you have to factor in double tax, et cetera. So from the bank's perspective, certainly the pricing piece, the complexities has to be considered. Certainly the political piece of it, depending on what state you're in. Mike and I are working on a deal in New York right now. And New York has been, obviously, DFS has been very positive with these transactions. But it's certainly unprecedented. And then as far as the credit union side of it, I think outside the integration piece, because you're generally onboarding new lines of business from the commercial lending perspective, we spent a lot of time dealing with nuanced issues with field of membership, how to deal with impermissible assets, things of that sort. So I wouldn't say one side's easier than the other. I think they're just equally challenging for different reasons.
Mike, you want to chime in?
I will say, from the buy side, I think there are a couple challenges that Jeff said, and I'll say it just a little bit differently. But I think as a buyer, to be a successful and effective buyer, you have to be able to convey your price in a way that then translates to the shareholder. So you have to know what you're doing. You have to be able to explain to the seller, hey, we're going to pay you X, and we're going to cover the tax, and we're going to do this such that your net will be Y, right? So we help tell that story to a seller to save the confusion or mistake and bring a lot of clarity to the transaction. And then second, look, as a seller, I don't know this, I'm not in that room, but I can get it by deduction. They care about how much they're going to get paid, but I think they also care about if they're going to get paid, right? You can agree to any deal you want to agree to, but if you don't close, nothing ever happens. So I think as a buyer, you have to, one, bring price certainty, but two, bring closing certainty. And so we work really hard pre-deal to vet ourselves such that we can go to a seller and say, hey, look, number one, we know what we're doing, right? We're not idiots. Number one, we know what we're doing. Number two, our regulators, love us. We don't have any challenges. Number three, we can close this deal. Here's how we can close it, right? We're going to bring a formula to this where we've closed 62 other deals in the last 14 years, right? Just like this, et cetera, et cetera. So we're very specific, very direct, and laser focused on explaining to a seller, one, how much money they're going to get, and two, the fact that we're low risk and are going to close the deal to try to help them navigate the waters that Jeff described, which are the deepest, murkiest, most scary waters for a seller. And I'll just add that many of these banks we're buying, right? Jeff alluded to this. It's a family that primarily owns it, or it's a small group of people, or it might be a significant institutional investor and then a family. So this is a small group having their liquidity event. It's meaningful for them generationally. And so the risk here is high, or the nerves are high. And on both sides, there are pressures to try to alleviate that. And there are specific things that both of us do, I think, because this is our focus, that are unique and that bring extreme value and clarity to a transaction like this.
Oh, yeah. And to Mike's point, too, to reemphasize, being on the bank side, you're going to factor in who, beyond who the credit union is, the size and their business, who the advisors are, the thoughtfulness of the LOI, the price mechanics. Because, again, you want to go to the board, not what are they paying in, what are you getting out of this? What's the per share number that's shareholder basis? And that's how the board has to make their decision from a fiduciary duty standpoint.
I appreciate those thoughts. And Mike, that is, really interesting to think about. This is a family institution, probably maybe 100 years old. This is a legacy. So that's sometimes lost in this. So the next section, I'm just going to kind of rip the Band-Aid off. The elephant in the room, right? There's controversy to these transactions. You guys know it. There's lobbies against these transactions on both a national level and sometimes a state level. I mean, you could say that from the ICBA's perspective that these types of deals are publicly reviled. I guess basically, and I'll let you guys answer, but due to that tax ramification element where the tax revenue is lost when a public or a for-profit entity is absorbed into a nonprofit entity. So how do you overcome this obstacle? And you guys are both prominent members of this entire national banking community. How do you also overcome it, from a professional basis? I'm not trying to make you feel bad about what you do, but it's just an interesting factor here.
If you don't mind, I'll start, just kind of set this stage just so it
Please do.
have a little clarity. So let me explain that. Brian, you're correct, but let me just add some guideposts here. So nationally speaking, a credit union's ability to buy here has kind of never been questioned. It's not under threat. What has occurred, and by the way, for nationally chartered banks, we can do those deals wherever we want, whenever we want. That also hasn't been in question. What has occurred on a limited basis? The banking lobby has gone to various states, and actually challenged or taken away a bank's power to sell to a credit union. That's what's so somewhat mind-bending here, is advocating to take power away from their constituency because of the vitriol and the political discord. And I don't criticize either lobby. They're doing their jobs, right? More power to them. That's fine. But understand here that any challenge has always been the bank's power to sell. Now, I'll tell you, this has ramped up, no question. Last year, I testified in 4 different state legislatures. This year, it's already been 2, and I think there are more on the way. Again, to talk about what these are and what they're not. What I believe is occurring is this is kind of sexy, emotional, exciting, and it's easy to say, hey, credit unions are buying banks, they should be taxed, right? Doesn't that kind of roll off the tongue? And so I get it. I don't disparage it, but what I say is time out. Let's actually look at what's occurring and what's not. And I think we need to look at the facts here. And in the end, whenever I testify, I explain that these transactions are not hostile takeovers. In fact, they can't be. They're 100% voluntary on both sides of the deal. And that really, I think a bank should be allowed to have a choice if they want to sell to another bank, to an investor group, to a credit union, to the man on the moon, right? As long as it's safe and sound, I think a bank should have that freedom. And I think a credit union should have the freedom to buy if they're so inclined. I think the market should be a free or open market. I think there are other arguments on other matters that need to occur, but this isn't that space. I just think, Brian, due to the emotional nature or the sexy nature of it, it gets kind of lumped in there, unfortunately. But it will keep happening. And in fact, recently it's happening more and more than it ever has before. I mean, this is definitely the suit of the day. I don't know, Jeff, what you...
Yeah, I'll bring a little bit different perspective to what Mike said. Mike raises very good points. I think what gets lost, Brad, you mentioned the tax. So number one, these deals are taxable. Bank-to-bank deals are not taxed at the corporate level. Credit union bank deals are. So there is a taxation element to this, number one. Number two, yes. Do credit unions have sort of an advantage? I mean, the big advantage with the not paying taxes is the earning accretions. They're looking at earnings on a pre-tax basis, which makes the deal more accretive than a tax-paying bank. But I would say the biggest advantage credit unions have, what the banking agencies don't understand or appreciate, is that credit unions don't have shareholders. My personal view is if we tax the credit unions tomorrow, so we're going to tax you, the M&A activity would still continue without question. Because if you're not paying tax, if you don't have shareholders, you could take a much more long-term outlook in terms of evaluating a deal versus if you're a publicly traded bank, you're evaluating your numbers quarterly. Your institutional shareholder has, pricing guardrails that you have to follow from a tangible book value dilution, et cetera, that frankly credit unions will have to deal with, just like mutual banks. The reason mutual banks aren't buying these little banks is, Frank, there's just not that many. There's only a finite number of multi-billion-dollar mutual banks that are well capitalized that can do it. Where in credit union world, there's hundreds of credit unions that can do that. But the fact that they don't have shareholders is why these deals happen. Way more so, in my opinion, than the fact that they don't pay taxes. You take taxes off the table, they're still buying banks without question.
Yeah, and I'll just finish the thought by saying the tax thing is a bit of a red herring here, because practically speaking, everything Jeff said's accurate. And then add to that, for what it's worth, I don't know, Jeff, if it's half or whatever, but a material amount of the banks we're buying are S corps, and they're not paying tax anyway. Or the banks we're buying
they're not making money.
They're marginally profitable. Like their federal tax bill isn't such that when we do our analysis, there's like some massive windfall because we get the pre-tax earnings. There's no tax being paid anyways. But I'm not trying to be disrespectful. I mean, C Corp banks pay tax, no question. But in reality, the not having shareholders, the fact that we're buying S Corp banks, the fact that C Corp banks we're buying, many aren't making much money. The tax is emotional. It's a red herring. There are other things that we should be talking about, other fights to have that are legitimate. This isn't that. It just doesn't.
Well, and the last ad, Brian, you mentioned about for us, or like how we're perceived as we're counsel. We're not Luse Gorman and Mike. I won't speak for Mike's firm, but we're not policy folks. But interestingly, we've had debates with state regulators. Minnesota's example is not a friendly environment, and as a real live example, I have a small bank client. Actually, Mike, you and I were potentially working on a deal with a credit union. And Minnesota is not receptive to a credit union buying a bank. And we were talking to the regulators. I said, when you realize this bank, less than 100 million in assets, there are other realistic buyers going to be an investor group. And the real value to that's going to be the bank's charter. They're going to want to relocate the bank, exit that local community, not invest. How is that worse? How is that better than a credit union that wants to buy that bank, preserve those branches, preserve those executives, employees, invest in that local community? I just don't understand from a policy perspective why you would say, well, I don't want this bank selling to a credit union, yet you're comfortable with an investor group buyer who's literally going to pull, that institution from that local community. So just these arguments are just a little bit, look, at the end of the day, and look, we're very friendly with the banking agencies, but it's a little bit of gamemanship to kind of fire up the membership base, in my opinion. You got to have, who are we fighting? And look, and there could be other reasons with the tax exemption, and that's fine. But in terms of the M&A piece of it, I think it's a little bit misguided. That's giving them this great advantage to buy banks.
Yeah. Great. Well, I mean, there's no way around it. And, I'm in this industry with you. And over the next 10 years, there's going to be less and less banks. I mean, it's just it's the nature of this beast. Mike, I was thinking back, I don't know, several years ago, I think we were trying to figure out a way to do a podcast like this. And you mentioned a credit union, a bank that was sold in, I think, the Southwest, where maybe the CEO was like almost vehemently against selling to a credit union. But then the transaction happened where he actually had a credit union buy his bank, and he warmed up to it, and he realized it was a great match. Does that ring a bell? And also, I guess that's kind of an interesting facet here is the banks themselves maybe have this stigma of like, I shouldn't be selling to a credit union, but it's my fiduciary responsibility to sell to my shareholders to make the best decision for them.
Yeah, Brian. So number one, I do remember that story, and that remains true today, by the way. But let me explain that. In these deals, it's certainly about price, and there's a fiduciary obligation, and there's a lot of the math piece, right? Don't get me wrong, and we deliver the math in an all-cash way. But there is a softer side to a deal, and in general, a credit union buyer, right? We're going to tell our story, and that is we're going to hire most, if not all, the folks. One of the reasons we're buying this thing is because we want your branches, and we keep them open. And then also, by our very nature, right, we're very active and very supportive of the community, like you are as a small community bank. We're going to do it the same or more than you have. All three of those things are real, and they're facts. And you can argue politics all you want, but those are facts. And that matters. And so many times in these communities, we've done these deals, and it is a good story. And the exiting management or the family that own the bank or even the institutional investor that cares because they're in the community bank space has a win here, not just on the dollars. And I'll tell you that it matters, I believe, if the sellers really think about it. If they really think about, do we want an investor group? By the way, there's great investor groups. They're not evil, but Jeff's points are accurate. They have different means and different things they need to do, or an upstate bank or something like that. So I will just say that these soft issues matter, and I can't give you the exact statistic, right? But I can say if I look back over, the last 50, 60 deals that we've done of this nature, honest to goodness, my buyers hire all the folks. Or a very minority. And then sometimes the folks who retire, we talked about succession issues. They're not available for hiring. They're retiring. But the strategy here is a bricks and mortar, a talent and capabilities type strategy where part of the value is the people. That's a huge part of the deal. And bank buyers, no fault of their own, because they have shareholders, because their math works a different way, they need savings. And Jeff, you can talk about this better than I, but they need to find savings in heads, right? They need cost reduction where the credit union doesn't necessarily need that. And that's a big deal.
Yeah, that goes back to the no shareholder point. You could do it, where if the general rule of thumb is you want to try to extract 35-40% cost saves, if you're a traditional stock bank buyer, a credit you can go in and say, look, we don't need 35-40% cost saves. We could do 10, 15. I mean, there'll be some efficiencies as a result of the deal. But in terms of the employee element, the personal element, the human capital element, the credit unions can keep everybody. The other thing I'd add too, in terms of the synergies, most of the selling banks have very little, retail consumer lending platform, and credit unions don't have a very robust commercial lending, business model. So when the two parties come together, they provide sort of complementary lines of business. So credit unions can come in and say, look, we want you to keep doing what you're doing. But, if you're a multi-billion-dollar credit union, now we can provide your lenders with larger, lending limits. But we don't really want to change everything. We want to keep everything intact. But here's what we're going to add to what you're doing to your customer base. We can really build out your consumer lending profile or business. And quite candidly, this is very well received by the regulators because, when you go in for approvals, the first thing they're going to ask, particularly the FDIC, is, are we closing any branches? Are employees being laid off? Are we eliminating, customers' access to banking? Are we getting rid of products and services? And the general answer to that is no, we're not. We're keeping everything intact, which is what generally well received by the regulators.
Yeah, well, you answered a few of my upcoming questions in those thoughts, and I appreciate that. I wanted to change the topic to geography. I talked to a bank investor last week. I mentioned this webinar that I was shooting, and he was really just kind of interested, and so am I, on how geography plays into these transactions. There's so many different examples of like a Michigan-based, was it Ryan Goldberg's credit union? I think DFCU bought a Tampa-based bank for Citrus. And then again, was it Lake Michigan Credit Union bought another Tampa-based bank, Pilot Bank shares. And obviously, Mike, you were in Michigan. You lived in Michigan. Now you live in Florida. It seems like there's, some drive there. But help me understand how, where are the banks that are selling to credit unions generally? I know it's a pie in the sky question. And then where are the credit union buyers generally? How does that match up?
Yeah, I would say I'll start with that, and Mike obviously can pipe in. But certainly, if you look at the Pacific Northwest, the Midwest, the Southeast are kind of the primary areas. And I would say what drives a lot of the activity, with these, there's no, and I tell clients this, even regulators, where you're going to a state where the deals have never been done, there's no playbook, there's no regulations, there's no real infrastructure of how to do these. A lot of the mechanics to getting these deals done are policy driven. So if you find a state, take Illinois as an example, we've had a lot of deal activity in that state. you sort of, because a few of those credit union bank deals have gotten completed successfully in that state, that kind of builds precedent, a regulatory playbook, infrastructure, how these do these deals. And I think as a result of that, banks in that state now say, okay, look, we've seen our peers sell to credit unions. Clearly, these deals can get done. It's a favorable regulatory environment. We are now going to add to the mix outside of bank buyers, credit unions as well. So I think that's very, very helpful. Conversely, that if you go to states where they haven't been done before, that could present, greater risk. So I think that's why where you have success in one state, you see more because you have that sort of basis precedent infrastructure built versus try to do it organically or from scratch.
Yeah, I agree with Jeff, because there is, someone's got to be brave to be the first. And I think we've done the first in 18 different states or whatever, and someone has to do it, but there is momentum. But I'd also say two things. One, I think you can look, right, at the number of small banks or $1 billion and less banks and where they are to kind of draw a heat map, and maybe you'll see the activity higher. Because remember, that's our spot in the market. We're not talking about buying a $2 billion bank kind of a thing. These are community banks. So Illinois, they have hundreds and hundreds of smaller banks, right? The upper Midwest, the Northwest, the Southeast. So that plays into it for sure. But I will tell you, I do believe, and I've kind of thought this through, there are buyers in all 50 states, in my opinion. I think if you look at the credit union industry, there might be 4,000 or 5,000 credit unions. I think there's probably 200 where this is applicable. Like, let's just be honest, or maybe 300, right? But I think they're in every state. And I do expect, as Jeff mentioned, he and I are on a deal in New York. It's a first ever. I do expect to see more first ever type situations happening this year and next year and the year after, because this is becoming more known, more expansive. I expect to hear about things in states like Texas and California and some new frontiers where we haven't been. But trace the small banks and where they are, and that's where these deals are going to be, right? Just in general.
Is that a New York credit union and a New York bank, or is it another from outside of New York?
No, it's New York.
Okay,
Correct.
Got it.
Yeah.
But again, I guess I'm still trying to wonder why an Upper Midwest credit union would want to have there's the snowbird effect, I guess. Why you'd want to have Florida franchise, Yeah, please do.
Yeah. So we helped Lake Michigan buy 2 different banks in Florida. We did the DFCU bank, and they're doing a branch deal. So I think that you could, as you mentioned, naturally look, a credit union in Michigan or in the Upper Midwest could look and realize, hey, I've got 2,000, 5,000, 7,000 members along the Gulf Coast, right? I mean, that's snowbird effect.
Yep.
Sure. But that doesn't make a deal, right? That might be part of the deal. But here's what makes a deal: geographic diversity, right? The economy in the Upper Midwest is different than the economy in the Southeast. Right? One's not necessarily better than the other, but I'm saying it's different. There's diversity there. What comes with diversity? Less risk, right? Loan and deposit diversity, done. Talent and capabilities are different, done. And so I give some of these Michigan credit unions, by the way, Michigan's a strong credit union state. There's a lot of large dynamic credit unions there. MSU Federal, Jeff's Client, LMCU, DFCU. You're going to see more of this happening. These strong credit union states like Michigan, Wisconsin, Texas. There are some that just, have bigger collection of credit unions. Having geographic diversity be a big play, and then buying out of state. Banks do this all the time, and they do this all the time. Jeff knows it better than me, but they seek geographic diversity, Jeff, don't they? For a lot of great reasons. And I'll tell you, the regulators are receptive to this because it does reduce the risk. One thing that's going to tank the economy in Michigan is not going to tank the economy in Florida. It just isn't. And so what better hedge than that very thing? What do you think, Jeff?
Yeah, I would agree with everything Mike said. I would add, I think the dynamic with Florida is a very favorable regulatory environment for credit union bank deals, number one. Number two, I think the type of banks that are available in Florida has a plethora of banks sort of in that asset size sweet spots for large credit unions, anywhere from 400 million to $1 billion. And these are highly performing, highly efficient institutions. And thirdly, to Mike's point about geography, we were counsel to Dort Financial Credit Union. They bought Flagler Bank in West Palm. And when we went to the regulators, sort of why did we want to do this? when Dort did sort of a deep dive into their field of membership in Florida, I mean, they had members all throughout the state. I mean, the concentration of members that these out-of-state credit unions have in Florida, it was quite staggering, compelling. So we went to the regulators, like, as to why we're doing this. Well, here's why. Beyond, diversifying our membership, our products and services, et cetera, there was real geographic synergies for doing this deal. I mean, because Florida's just booming, and people from the Northeast and the upper Midwest are, moving down to Florida or having second homes there. So it just makes a lot of sense from a business standpoint. And so that, again, each state, each situation is different, but Florida in particular is you seeing a lot of, because of those synergies, we're going to anticipate a lot of, credit union bank activity in that state in the near future, without question.
Yeah, and Jeff's right. If you drive around, look, I moved from Michigan to Florida, right? I'm Exhibit A, but look in Florida, years ago, Fifth Third Bank from Ohio, right, from the Midwest, came to Florida. Surprise, surprise. Liberty Bank is a great little bank. They're in Ohio based, if I'm not mistaken. There's one in Sarasota, very close to my house, right? So this is not like some new secret. This geographic play.
Valley National Bank in New Jersey, same thing. They did a few deals in Florida. 100%. It's
Northeast, Midwest, and Florida or Southeast has been in the bank game a long time.
Yeah.
Right. This is not new secrets.
Yeah. And then I think it goes back, Brian, to what I said earlier. You also have sellers that want cash. And, that's the other thing, again, it's supply and demand. If you're, look, I've been on the bank side of this. If you're $600-700 million in assets and your board and your shareholder base is very closely held, and the board's marching orders is, look, we can sell, but we want cash. There's just a limited universe of buyers who could do those deals. It just is. Like it's quite candidly, it's credit unions. I mean, even banks, large cap banks, they just don't have, they could do stock deals, but they don't have the capital to do an all cash deal, to do a $50, $75, $100 million deal that a credit union could do. So it's basic math as well.
Well, I appreciate that. Yeah. And it's a good point. Yeah, there's just been an influx of population into the Southeast. And when I do search work, every other candidate asks me if I have any roles in the Carolinas or South. So it's where everyone wants to be.
Yeah.
So we're running out of time here, but I guess my last question is, well, there's kind of a two-parter. So the cultural element, again, perception. I'm a credit union member as well as a bank client, customer. So, I've seen both, and there's a perception that credit unions may not be operationally or technologically as advanced or progressive. There are several exceptions to that rule. Don't get me wrong. Banks also, smaller banks, can be seen that way too. But, I guess I'm just kind of curious culturally how those marriages work internally, operationally, from kind of a cultural mindset of an employee. And then the other side is the customer, the member. The customer kind of has to become a member, so to speak. Is there churn in either side of that question? You hear from your clients?
I'll start by saying I think that you could look at the industries as a whole and find all these differences. But I think if you zero in on the people Jeff and I work with on the buy side, those 200 to 300 credit unions, and then you zero in on the 3,000 to 4,000 banks that we're buying, you would find that we are kissing cousins, right, for the most part. Okay. And I'll tell you, I've seen this translate on the employee and on the customer side. So I think, Brian, in a deal, you might have one or two employees, self-select and not continue because the culture. And then you're going to have 98% of the other employees be pretty excited, say, hey, this is a lot like where I worked, and it just so happens to be a little bit bigger with better room for advancement and et cetera. And same with the customers. I think if you talk to the buyers that Jeff and I work for, they would say to you that there's little to no runoff, number one. And number two, depending on where you work and what you call it, there's wallet share or product per household gain that is rather material and happens pretty fast after closing because of these customers taking advantage of things they didn't have before. And that's not a hit on the bank or a thing for the credit union. I'm just talking practically speaking, what you were taking is a $5 billion institution buying a $500 million institution. There are differences. And in the end, it pans out that employees and customers stay and take advantage of the situation.
Yeah, I would just add to what Mike said. I personally don't find the technology piece as sort of the roadblock. I think where banks criticize a credit union buyer, particularly if you're a true traditional commercial bank, is how would their commercial clients feel banking with a credit union? Because credit unions just reputationally don't have, they're not known as commercial lenders. That's not their forte. That's not. So, and I think one of the ways to kind of mitigate that, particularly when we're representing credit unions, is that you got to get buy-in from key people and talent on the front end. And you got to satisfy that before you sign a definitive agreement, whether that's the CEO, the chief lender, CFO, whoever that may be, because you want those folks boots on the ground, ready to go on legal day one, just to kind of preserve that line of business. But that, I would say that's probably the biggest culturally hurdle in terms of, bringing credit union banks together from what we see.
That's a great point, Jeff. Yeah, because it's consumer versus commercial, credit union bank. That's also the perception. Well, in any event, I can't thank you guys both for being on Travillian Next and hanging with me today. I respect both of you. This is a trend that I've heard loud and clear. There's going to be a ton of it this year. So we're going to keep our eyes and ears out for more announcements from both of you.
Right. Pleasure to be here.
And best of luck with both of your future endeavors.
Yeah, thank you.
Thanks.